last year we've seen the markets reached record highs both locally and offshore. But what can we learn from last year that we can take forward into 2026? Now, to help us answer that difficult question, we've got PW Nel, investment specialist with Allan Gray. PW, welcome. And what can we learn from last year and actually take forward into this year?
Thank you very much, Hugh. That's a great question. I think last year was an incredible year. We saw record performances, and I think the South African market, when measured in dollar terms, was up 62% last year. But let's just recap what some of those performance drivers were. We can extrapolate that into 2026, and potentially we could give you a bit of an insight into where we think the opportunities lie from an investment perspective. So in quarter one of 2025, we really saw a lot of these South African incs, so companies that earn the majority of their revenue locally. We saw the optimism around a lot of these companies starting to fade. I think investors started to question, we've got a lot of optimism in our local market, and we've got the GNU, so there's a lot of positive sentiment, but what does it actually mean for growth? Will we see infrastructure spending picking up? And I think a lot of that optimism started to fade, and a lot of these South African-focused companies started to sell off. In quarter one, we started seeing a lot of the rand-hedged companies, so companies who are well-diversified globally, who earn the majority of their revenues overseas. They just happen to be listed on our local exchange. A lot of these companies moving back into favor. I think the massive returns that we saw on our market has really been masked by a lot of volatility. And I think a great example is from Donald Trump, where he announced tariffs in quarter two last year. We saw this big sell-off across world markets, and although the majority of the markets recovered last year, something that really didn't recover was the dollar. And we've seen throughout last year how the dollar has been under pressure, and potentially investors who invested overseas, some of the returns that they made on the offshore markets are a bit smaller just because of that rand strength.
But just before you continue, and that's an interesting point you made on South African listed companies on the JSE, because people look at the political side and they don't understand why the markets run. But we have to remember, as you mentioned, that a lot of the revenue is actually earned outside of South Africa. It's not just SA Inc. companies on the JSE, and that's an important point that I think investors often don't understand.
Yeah, I think from a South African market perspective, we are quite fortunate. I think a lot of the time investors think we stay in South Africa, the prospects of our local market is completely tied to what happens in our local economy, but that's not the case. If you actually look at our market is quite diverse, and there's a lot of different companies listed on our market. So they've got some good quality banks, and these banks don't just earn revenue locally in South Africa. Some of them, like a Standard Bank, earn a lot of revenue from Africa. So it's quite a diversified business. But then we've also got big listed multinational companies, something like an AB InBev. They earn revenue from across the globe. So well-diversified businesses listed locally on our exchange. And then maybe a last example, something that's been very topical, is our gold or platinum mining companies. So they happen to be listed on our South African stock exchanges. They might have some mining operations locally, but they also have mining operations across the globe. But a lot of the revenue that they earn is tied to the gold price, for example. And as that gold price has increased, these mining companies have made a lot more profit.
Yes, and especially resources drove a lot of our market, as you mentioned. But when we look offshore, and we have to look at the Magnificent Seven stocks, the stocks that's driven by AI, Microsoft, Meta, Google, all of those stocks, they've really done well in 2025. But it's expensive now.
Yeah, that's right.
What's your take as Allan Gray when holding that stocks? Is it still time to buy in going forward, or is it too late, or do you just hold your position if you do have one?
Yeah, okay, that's a great question. I think the Magnificent Seven, they've dominated headlines, and there's a lot of excitement around these companies. I think for us, and our view is, we do own Alphabet from the Magnificent Seven, but we don't have exposure to the rest of them. I think when you look at the market currently, there's a lot of nervousness around specifically these Magnificent Seven companies. The market is starting to figure out, or trying to guess, there's no concrete path forward to understand the capex that these Magnificent Seven companies are spending. And they are spending extraordinary amounts to develop AI. Will it actually benefit return at the end of the day? And I think you're starting to see some of the Magnificent Seven starting to sell off a bit and giving back some of those phenomenal returns that they've done over the last couple of years. I think how we think about it, if you look at our Orbis positioning, we position slightly differently. So we do have exposure to this AI theme, if you could call it that way. Like I've mentioned, we've got exposure to Alphabet, but we are choosing to access this AI theme in other ways that are a lot more attractively valued. So for example, owning the pigs and the shovels, for example. It's owning a company like Taiwan Semiconductor, a chip manufacturing producer. It's having exposure to cloud infrastructure providers, and also even accessing some great opportunities for companies who provide the power for the data centers. I think a lot of the time, certain narrative drives markets, and investors overlook some of the other opportunities that are available. And I think a lot of news flow has dominated specifically around the Magnificent Seven, but it's also caused other sectors to fall out of favor, and you're able to buy really great quality companies at attractive valuations. But from an Orbis perspective, one of the opportunities that we found is biotech companies, and these companies are trading at very attractive valuations. So we've positioned a bit in there. And then also we've invested into some defense companies. As we've seen this period of relative peace come to an end, a couple of years ago we invested into a lot of these defense companies. And as countries have been starting to ramp up their defense spending, these defense companies have done really, really well. So there's definitely other opportunities outside just the Magnificent Seven.
And of course, when looking at these massive companies, especially when we talk about AI and the tech sector, do their earnings actually make sense? If we look at the valuations of these companies, does the earnings make sense? And especially looking at also what they actually spend. Lots of spending on research and development, lots of spending on AI. Is the earnings that they are showing actually, does it make sense to buy these type of companies? And once again, you actually just gave us the answer, but looking forward, is there any opportunities really?
Yeah, we don't think so. So as I've mentioned, we've got a bit of exposure to Alphabet. We think they're well positioned to benefit from the AI development, as well as it's still a solid business underlying. They've got a lot of advertising spend still coming through. But for the rest of them, we think the valuations of these companies is very, very stretched. And for us, the price you pay is the best determinant of the future return that you will get on that company. So we think some of the prices that you are paying for the earnings growth of these companies is just way too high. And then also they are spending, so these companies used to be very capital light, and now they're using a lot of their revenue, reinvesting it back into CapEx to develop AI. But
so sitting on less cash.
Yeah, exactly. So it's not this capital light business that it used to be.
And I think you mentioned an important word there, the valuation of a specific share. Because we need to take emotion out of it as asset managers, as financial advisors, because people can easily fall in love with the stock. You own an Apple phone, so you feel you must buy the stock. You fall in love with it. Or you like the CEO, you buy the stocks. And all of those we know are the wrong reasons for owning a specific share. And I think you definitely alluded to what's the valuation. Let's take emotions out of it. What's the valuation of those companies? And then, yes, it does look expensive going forward. Talk about going forward. People come with us, with the money to us. Now they want to invest. Is there a last theme? Is there a last opportunity you see in 2026 that we should not miss out on?
Give us your crystal ball moment.
Yes.
if only I had one. I think in the current market environment, I think there's still a lot of risk and a lot of uncertainty. We've got a lot of geopolitical risk. So it's not the time to bet the farm on one single outcome. You need to be positioned for a range of different outcomes. So there are some sort of sectors or themes, if you call it that we found opportunities in. But very much what we do is we look to understand companies really, really well. And we look to buy these companies when they are trading at less than what they are worth. So I'll give you a few examples. Some of these SA Inc. companies that sold off last year, we're starting to look at some of those opportunities. Consumer staples, they've also been unloved for a while. There's a bit of negative sentiment around that. We found some opportunities there. And then perhaps something that is a bit different, where we found some opportunities more recently, is in the frontiers market. So Allan Gray, we run quite a big frontier market fund, And there are about 3,000 different stocks that you can invest into in the frontiers market. So you're able to buy really good quality companies with good earnings growth at low valuations. And that's in countries like Kazakhstan, for example. That's also somewhere where we found opportunities and we are quite excited about.
Sure, Kazakhstan, that's interesting. Yeah, and I thank you very much for your time. And I think at Allan Gray, you believe in long-term returns.
That's right.
As well.
Absolutely.
And definitely people, if they choose their own stocks, they can be right for the short term. But we've seen time and time again that if you do your homework and you buy the companies for the right reasons, then in the long term you will benefit. So thanks for that.
Thank you very much.